Good morning. It is a perfect day for a webinar today. I was in Iowa yesterday talking about all these products we're going to talk about today, and it's supposed to be a big snowstorm. So for the guys out west that are already getting it, this is a good day to sit down and talk about this. But for the guys that do not know me, my name is Trevor Froling, and I work with CommonGround Insurance Group. I'm really glad that all of you took some time to join me this morning. We have a few different products that I have really been excited to talk about with my growers this spring, and I have been getting a lot of conversations, a lot of optimism on all of them so far. So to break them down, I have a bunch of acronyms here on the screen. We're going to use these acronyms throughout the morning. It's going to be my goal is 30 to 40 minutes and get it nice, short, and sweet and to the point, and then everybody will understand it by the time you get out of here. So to start, CLIP, the acronym. So CLIP is Cash Lease Insurance Protection, and this policy was created to help growers protect in case of a price decline going into the fall. So every year there seems to be some kind of weather event, scare, or news event that makes the market shoot up. It's hard for a farmer to take advantage of those markets, not knowing, what kind of crop they're going to have. If they don't have a crop, prices will be a lot higher in the fall. There's just a lot of uncertainty. So what Clip does is it helps those guys be able to lock in just the price and then get paid on price decline. And we'll get into more how that works. The second product is band revenue protection. So band revenue protection is essentially an add-on to your RP policy. So for those of you that buy 80, 85% RP, this is a band that goes on top of that, and it allows you to have up to 95% individual coverage on your farms. It's been a real game changer for me so far this spring. The bankers that I work with love that policy. It's a 95% policy that pays you right away in the fall. Unlike county products, an ECO, a ARP, SCO, the BRP can be paid right away in the fall, right along with your RP. So it's about a 10% higher deductible than the highest federal subsidized product goes, 85%. So if you have a 200 bushel average, it adds about 20 bushel onto that. So it's a big deal. And the final product we're going to talk about this morning is My Yield. So My Yield is an endorsement that you can buy along with your band revenue protection. It allows you to use your highest bean yield per farm on your band product. So if a person has that 95% coverage, essentially you can trade out your APHs on the beans for whatever the highest producing year on that crop was. Now we'll get more into that, how that works, but that's essentially what we're talking about this morning, and we'll get right into it. So starting off, what is CLIP? Cash Lease Insurance Protection. It's a non-federally reinsured supplemental product created by Hudson Crop. It allows a producer to elect bands of coverage to lock in a market price. Now, these prices are based on this year, December 25 corn, November 24 beans. So a person could buy this morning. It's based on the prior trading day and opens at 8:30 in the morning, and it's open for about 3.5 hours every day. You can buy it every day that the market is open up until last year, our deadline of July 31st. So I was literally talking about this every day last summer to growers. It was relevant just about every day with how volatile these prices are anymore. It's something that's really relevant to everybody I work with. So it has daily price offers that provide flexibility on a per farm basis that guarantees outside of federal crop insurance. So what I like about this is it's totally separate from your federally subsidized crop insurance. This can pay and not have any effect on an indemnity of RP or any county of insurance, and it's totally based on price. So if you're betting, we're going to have lower prices in the fall because we have a bumper crop, you can lock in that higher price in the summer when the risk is the highest and not be punished by it like on an RP policy if you have a really good yield in the fall. Now, this can be purchased by farm lease, and unlike federal crop, it can be bought on a per farm basis. So what's unique about this is when you buy your, county insurance products, individual insurance products, you're buying them and it's got to be by county, by crop. What I really like about this product is it was created to be on a per farm basis. So every individual lease that you have, this policy can be written per lease on those farms. So it really gives a person a lot of, maneuverability in their marketing, because if you have some farms that are higher rent, you can lock in this insurance just on your higher rent acres to help you cover that gap if the price drops in the fall. So it's price based with no yield calculators factor in. You aren't punished by a high yield whatsoever. And it's purchased, like I said, from 8:30 to noon every day that the market's open. Now, where is CLIP available? Now, the majority of the states that I write in are listed here. We have the Midwest states: Nebraska, Iowa, Missouri, Wisconsin, Illinois, Indiana, Michigan, Ohio, Minnesota, Kentucky. So those are the main states I write in. Now, it's a private product, right? So everything is debatable with the insurance company. Could a person get this in another state? Absolutely. It's all up for discussion. As of now, these are my primary states that I've seen this product successful in, but it's a price only product, right? So wherever a person buys this, you're all betting against the Chicago Board of Trade in the fall, our harvest price on the crop insurance. So it really doesn't matter where you buy it. It's all affected just about the same and rated the same on the insurance. Now, this insurance provides coverage for loss of revenue for any acres that are cash rented with a valid lease agreement. So if you have a valid lease agreement, you can buy insurance on this policy. Now, what I also like, if you do happen to have a handshake agreement, there isn't a written lease, we can use other leases to take the place of the lease that is high rent. So let's say you have a handshake lease, a $400 acre rent, but you have a written lease that's $250. Well, you don't need $250 in the fall if the price drops. You only want $100. We can use the other lease to cover that high lease agreement and just basically substitute the lease, so you have the peril of the price dropping, and that way we can substitute the written lease for what it was. So now you cannot buy a liability limit higher than your total cash rent. So if a person has a $250 rent or a $400 rent, the liability of this policy cannot go any higher than the rent. And that's the peril that's covered by the insurance. So the only restriction we have is you can't buy more liability than your rent. So the total you can get back cannot exceed what you pay for rent per acre. Now, you do have multiple price guarantee lock-in options. So what I like about this is if a person wanted to do this in May, let's say you had a schedule, kind of like selling your grain. You say, okay, on May 15th, I want to buy some, June 1st, June 15th, right? Usually 3 periods where we have the highest prices in the summer. You could say, okay, on that $200 an acre rent, I'm going to buy $50 May 1st, May 15th, June 1st, June 15th. You can spread that risk on prices over the summer, over different price periods. So you can set it up in a way that you don't have to have all your eggs in one basket. You can spread it over more periods. Now, what are some key dates for this? So last year, I was selling these policies up through the last day of July. Now you're betting on this policy against the fall price in October for corn and beans. So we take the December 25 corn contract, November 24 futures beans contract. The average of those contracts in the month of October is what we're betting against when we buy this policy. So whatever those are in October, that's going to give you an idea of what the indemnity would be based off of, because that's what you're betting on. Now, like I said, the sales window on this is very sharp, right? We have about 3.5 hours every day. A person can lock this in. The reason this is because we're allowing Hudson Crop, who underwrites this, as soon as a person buys this, they're going on the board as soon as you lock it in and hedging your bet, essentially making it so their risk is curbed, right? So they limit how often the person can buy this. So that's really the only limitability we have on this, is we have a short buying window in the mornings. Now, what does premium do on this? So a reason I really like this policy rather than doing it through a broker is there's no margin calls, there's no money up front. It's billed right along with your private product crop insurance policies. So the same time you're going to get your hail bill in the mail is when this is going to be billed. Now, the indemnity on this comes at the end of October, right? So if there was a payment in the first week of November, it may pay off your policy. You may never even have to pay a bill, right? Because you're betting against the average in October. That first week in November, they're going to know what the indemnity is. They're basing it off of that number. Now, what are some policy advantages of CLIP? It allows for trigger coverages levels from 95 to 90%. And what that means is you can buy up to 95% of the price you elect. So if you picked $5 this summer and you said, okay, Trevor, I want 95% of that price. If it drops below 95% of $5, which is $4.75, I want to start getting paid back this fall. Well, that's essentially how it works. You're getting 95% of the price. The average of that fall price, whatever it drops below that per penny, you start to get paid. And we'll get into the math of that in a little bit. So it provides a floor coverage down to 80%. So it's a band product. The widest the band can be is 95 to 80%. Now, the tightest that band can be is 95 to 93%. Now, a little later, I'm going to show you my favorite version of this policy and where we had the most success writing this last year. But you do have options, right? The wider the band, the cheaper this policy becomes because you get paid back. You get paid back later, right? So at the $5 example, 5% trigger at $4.75, I start getting paid. If the bottom of that band is, let's say, 90%, at $4.50, you max out on the policy. Now, if your band is 80%, it's going to be cheaper because you don't get paid back 100% liability till $4. So the price of this, how much it costs, depends on the band. When you buy it are the two biggest ways that they can determine how much this costs. The later in the summer you buy it, the cheaper it gets. And the tighter your band, the more expensive it gets. So if you have a really wide band, cheaper it gets. The later you buy it, the cheaper it gets. So hypothetically, the cheapest this policy will ever be is a 95 to 80 band the last day of July, right? Because we have the widest band and the latest purchase period. So the losses begin paying as soon as the harvest price drops below the trigger. So first week of November, we're going to know if this pays. There's absolutely no yield component of this whatsoever. So you can have as good a year farming as you possibly can. The payment on this will not be affected by it at all. You're purely betting on that Chicago Board of Trade average in October. Now, this allows for liability payments larger than the actual revenue with a high band coverage. So what that essentially means is that the liability on this can actually exceed the revenue side of this, and I'll get into the math of that too here in a second. Now, how exactly is this all determined, right? So we talked about the tighter bands, the higher triggers. The spring price is not applicable to cash leases. So the spring price is irrelevant on this policy. Liability is based on the electric coverage, acres, and share. So essentially what we're talking about here is what we just covered, right? So the premium is covered by how wide our band is, how soon we get paid back, and the length of time we have between the fall. So you're betting against the average in October. The later you buy this, the cheaper it gets, is essentially what we're talking about here. So why should a person look at CLIP? Why does it make sense? So CLIP was created to be an easy way to lock in higher prices. Brokers can do the exact same thing we're doing here. The difference is I think we're doing it more efficiently and simpler to understand. And when you hear about something like this, reading off PowerPoints is, it's a hard way to understand something. But when I get into the later part of this, I'm going to show specific examples from last year. At that point, it'll kind of start to click for those of you like, okay, how exactly does this work, right? So why does CLIP make sense? So in an environment of volatile markets, CLIP allows farmers to take advantage of higher prices that are created by factors that make it hard to sell a crop. So every summer, I go out and I think, okay, I'm going to get so much of my crop sold by the end of July. The problem is if I have a late planting period, like I did this last spring, we had corn going in the last week of May. Our high for the year was the last week of May on corn futures. It's extremely hard to sell that crop ahead when it's not even in the ground yet. So what this policy allows a person to do is, okay, I want to take advantage of this higher price, not knowing what the price is going to be in the fall if there's a major problem. It's a hedge, right? So you think, okay, if this policy pays, I'm going to have a good year yield wise, right? We're going to have good crops. If it does pay, right, I had the good yield. If it doesn't pay, I didn't sell my bushels in the summer for a lower number. I can save my bushels to sell them for a higher price in the fall. So that's the big advantage of it. So with high ROI expectations from landowners, CLIP really does give the farmer a tool against defaulting on cash rent payments. So here at CommonGround, it is not uncommon for people to get, high rents. They're bidding on these farms. They're aggressive. They want to grow their operations. A lot of people have kids coming back to the farm. They need to grow in order to have enough for the whole family, right? So a lot of times we see rents in the top 10, 20% in the county. And what can a person do to kind of curve the risk when you do have a higher rent? They use this to be able to market the grain in the summer when the risk is the highest, and the grain that they can't market, they use the CLIP to hedge that risk. So they can take advantage of a higher price, but if it does have a tough year, they still have the bushels they can sell for a higher number in the fall. So in 2025, we could see a weather market, and CLIP allows us to lock in higher prices without committing the bushels. Like I just said, right? The key this summer is going to be marketing. Just like every year, 90% of farming is marketing anymore. I mean, if you could have a really good year farming, but if you don't market the grain right, it's still not going to math very well. So the key on this is having a tool where you can take advantage of them higher prices. So here's an example. So back in the summer of 2023, when this product was still being developed, right, we were finding a need. We had a major weather market in the summer of 23. As you can see here, we had a high of 627 in the middle of, late May, early June, mid-June. We got up to 627 when it stopped raining, right? Is it going to rain? Was the question. So we got over $6 on the corn market. Now, how many people do I know that sold, $6 corn in 23? Not very many, because they didn't know if they were going to have a crop, just like me. Now, just like 9 out of 10 years, what did it do? And it ended up raining, and then the price reflected that. It dived into the end of, June, early July. We had a little bit rebound the end of July, early August, but we settled in at a fall price of $4.88. Now, around me, if the fall price was $4.88 and a guy was harvesting their corn in late October, early November, they probably sold their cash corn for $4.50 that fall. That's a long ways away from high fives that a person could have gotten in early June, July. Now, if a person had CLIP at any point between June 15th and July 5th, right? So you had about a 3-week window where the market was going higher. We couldn't sell a lot of bushels. We didn't know what we were going to have. How many guys could take advantage of the price? Well, if you had CLIP, you could have locked in the higher price. Between that 3-week window, any version of this policy would have maxed out on liability in 23. Now you say, Trevor, now that's just 1 year. One example, right? So this is another chart. We got corn of last year, December 24. We got every trading day of the whole year on this chart. My favorite version of this policy was a 95-93. So 95% trigger, 93% bottom. So at 93% of the price you picked, you get 100% of your liability back, whatever you picked. If you can see here, 93% of 445 is 417. Anything over 445 last summer would have maxed out on my favorite policy. From late June, early July, back through January, if a person bought this policy, it would have maxed out. It would have maxed out at any level, 95, 93, back through January. So there was a potential on this essentially through the first week of July. If a person would have bought this policy, it would have maxed out. Now here's a soybean chart. The exact same scenario. So at 1080, a person that bought my favorite policy in 95, 93 would have maxed out. So when was that period, right? We looked at the chart. Sometime in late July, a person could have bought this January 1 through the end of July. They would have maxed out this policy because 93% of 1080 is over 1010, $10.10. Our fall price on beans was $10.03. So, because of the harvest price decline, which usually happens in October when we think we have a bumper crop, the price dropped for the whole month, right? So, this policy would have maxed out essentially 2/3 of the year when a person would have bought it. Now, why do I think CLIP makes sense to look at this summer? So, the 3 prior years, we've had a guarantee of 590 in 22, 591 in 23, and 466 in 24. So if you look at, what prices have done from 22 to 24 and now going into 25, we've had about a 20% price decline in that time period. Now for 2025, our spring running average right now is right around that 466 again. Clever enough as it is, it's about the same as it was last spring. The lower the spring price, the better CLIP could potentially look because we're looking for ways to create a higher guarantee right off of our base crop insurance. My question is, could another great crop lead to $4 corn on the board, sub $4 corn this fall? It was essentially there this fall. There's a lot of people I know that were delivering 360, 370 corn to the elevator. So could it happen if we have another bumper crop? Absolutely, I think it could. So a rally this summer with any kind of weather event could give us potentially the best opportunity to lock in a higher price. The best time period to buy this policy is essentially the best time it is to market your grain every year, right? May, June, July. The problem with marketing the summer, I can't sell the bushels because there's too much risk. I don't know if I'm going to have the crop, but you can buy the CLIP and lock in the higher price. If it declines in the fall, it's going to help you cover that gap on your cash rent. If it doesn't pay you on 100% of your acres, you made out better because you got to sell for cash corn, cash beans in the fall for a higher number. Because it's got to be higher if this doesn't pay because it would have triggered. Now, when will CLIP pay and federal crop not pay? So let's say a grower has a 200 average and he buys the highest level federal government will let you buy, 85%. Now you lock in a 466 guarantee like it is right now, and you have 170 bushel trigger yield. You have a guarantee of right around $800. But using CLIP this summer, a producer locks in $4.70 on the board, and you have an 85% floor on that policy. So a 95.85 on 470. A $4 harvest price in October. So the average price in October is $4. CLIP on this policy, CLIP would pay full indemnity on whatever liability a person picked. But if a person picked $100, it'd pay you $100 an acre if you locked it in at 470. Now, what's the RP do? The producer producing right at his APH, 200 bushel corn. So he had just an average year, right? 200 average. The price drops 70 cents on his spring insurance policy. He has a revenue total of 200 times $4, $800. Well, his guarantee was $800. And on top of paying the premium on that policy, he's net negative on his RP policy. CLIP, on the other hand, would have maxed out. It would have paid $100 up to whatever liability limit they picked on the rent. So that's a situation where this would have paid out, maxed out, paid for probably his crop insurance for 3 years if a person would have bought it. Now, what I have here is a real world example, right? So I got 2 policies I'm going to show you guys that were real policies last year with my insureds, 2 totally different situations. So this insured rented a 40. They are 50-50 on that 40, and they had high cash rent. They said to me, Trevor, listen, I'm paying high rent. I got to get some money back if that price drops in the fall. Called me. It was probably mid-June to buy this. It was in Delaware County, Iowa on beans. The market price they picked, you can see here on the screen, was $11.04. Now, they had a 95% trigger on that. So anything under 1049 in the fall, they're starting to get paid back so much. The bottom of the band was 93%. So at 93% of the price they picked, they're getting 100% liability. Our fall price came in at $10.03. So he was 25 cents over the total liability limit. Now he said, Trevor, I want $60 an acre back if the price drops 70, 80 cents in the fall. It was only on 18 and a half acres. It was a 40, but he got a check for $1,110. His premium was $376. It was right at a 3-to-1 return on his money. But he said, hey, I'll take that $40 and put it in my pocket because the price dropped. And it helped him cover that gap when the price dropped in the fall. Now, here's another example on the higher end, right? We had insured in Barron County, Kentucky. It was on soybeans again. He picked his policy later in the summer, so it would have been late July. The exact same policy, right? My favorite coverage on this is the 95% trigger, the 93% bottom band. So at 93%, it maxes out. Now, his trigger on this was $10.65 was his price. His top coverage price was $10.12. So anything under $10.12, it starts to pay you back. His bottom on the coverage was $9.90. So at $9.90, it maxes out. He wanted $130 an acre if it got down to $9.90, and it was on 506 acres. So if it maxed out, he would have got a check for $66,000, but his premium was right around $19,000. It's about that 3.5 to 1 ratio. Now, here's the thing. So our fall price came at $10.03. It didn't get to the bottom of the band, but it triggered, right? We're at $10.12, so we're in the money. How much did he make on it? So the math on this is you take how many pennies that he had in his band. He had 22 cents. Now he gets paid $130 an acre max if it gets to $9.90, but it didn't. So what we figure out here is you take $130 of risk times the pennies in the band, 21 pennies, right? So he's going to get $6.19, a penny under $10.12. Now, our fall price was $10.03. So he's 9 cents into his band. You take $6.19 times 9 cents. He got paid $55.71 an acre. It cost him $38 an acre to buy it. But his check on this, $55.71 times 506 acres, he got a premium check. He got an indemnity check from us for $28,200. So he didn't max it out, but he did net $8,500 essentially on this policy. Was he happy with it? He said, Trevor, I'm happy with it. It paid, the premium. It covered a part of it. The beginning of October, he wasn't thinking it was going to pay. It was around 1070 to start the fall, October. We dropped all the way down to 950, 960 by the time it was over. So that extra $8-9 grand on 500 acres, it's $15 to $20 an acre. It helped cover a gap that was lost because he wasn't able to sell his grain for as much in the fall. So this is a higher end policy where a guy spent a little bit more money, wanted more coverage, and the other was before. But you can do either, right? You can do a lot of acres at once, or you can do as little as you want. But that is essentially how this policy works. Now, those are the examples I have. I'm going to get into the band revenue product next. But if anybody has any questions on this, please submit them into Silas, and we can get them answered at the end. Or we can always just set up an individual meeting too, where we can go through the different scenarios, how it works, any questions anybody additionally has. Now, here's a policy that's extremely easy to understand, but it's extremely needed, and it didn't exist before this year. So we covered price, right? 95% coverage on price. What this does is it covers 95% of your individual yield times price. So as we talked before, you can only buy up to 85% coverage on your individual insurance. This is a supplemental product that gets you to 95%. It's called Band Revenue Protection, or BRP. It's a private product that allows you to take your individual guarantee from 85 to 95%. You have to have a minimum 70% RP policy to buy this coverage, and this policy pays in the fall along with the RP. It allows you to get your money back faster, unlike county programs where you have to wait usually late May to early June. It's about 8 months longer than this policy would pay out. So the key on this to me is you're getting an extra 10% deductible and you're getting your money about 8 months faster than you would on the county policies. Now, my favorite version of this insurance is true RP coverage, where you get the higher the spring and fall price and 95% coverage. So just like on your RP, you have a harvest price option where you're guaranteeing the spring price, but you're going to get the higher of the spring and fall price. And I'll get into some examples of how that works in a little bit. So you can make this policy cheaper or more expensive by putting in a bottom on price decline. And you can also move the protection factor on this policy from 100 to 50%. So what I like about this is you can play with the numbers on this to make it less expensive, more liability as you want. It was created with a price decline factor. So if you wanted to limit the bottom price decline on this, you could make it about as cheap as you wanted to. You can do it in 5% intervals, which means, for example, let's say our price is $5 for the spring price. If you put a 10% bottom on the price decline on that, well, okay, at $4.50, I'm maxed out on my price decline. I still get 95% of my yield, but the price decline is limited to 4.5 if yields are really good. They're going to pay you for putting a bottom in that price decline because it's removing part of their risk. The same way you can get the protection factor changed, right? So if you have an RP policy and it's 85-100, for every dollar you're supposed to get, you get $1 of insurance back. So if your indemnity is $100, you can get $50 back, right? Or if you have $100 indemnity on your RP, you're going to get $100 back. That's what you get paid. Now, on this, what I like is you don't have to jump in head first. You can buy a percentage of this with a high trigger, but not commit to all that premium. So my favorite version of this is actually a 95% trigger, 50% liability. So you're paying half as much money to get half as much back. So if you do have a problem, it's going to pay you back faster. But if you have a great year and prices are really good, the policy's not going to pay anything, right? Which is what we all want. But if it doesn't, you didn't have to, spend a lot of money to do so. So this policy is available in enterprise unit only and will cover 95% of yield across the farm on APH, or possibly highest per unit on soybeans with the My Yield endorsement. And I'll show you that in a little bit too. Okay, so here's an example of the policy that's my favorite version of this policy. So what we have here is a quote from, I ran this yesterday with my growers. It's in Palo Alto, Iowa, and it's on corn, and their base insurance policy is RP. Now, the liability limit on this is 50%. That means they're getting 50 cents for every dollar they're supposed to get, right? We have a harvest price decline of 10%. We're putting a bottom in at 10% on price, and our projected price is right around $4.70. So what we have here is a 95-85 on 1,000 acres, 100% share. The APH is 200. So the trigger on this 200 APH policy is 190 bushels. So anything under 190 bushels starts to pay you back. The premium on this is only $16. So for $16, you can have 95% coverage, individual across the farm on corn, and you can still get about 3-to-1 back. It's about $47 an acre you can get back in max liability. So you can still get paid back 3-to-1. It's just the difference is instead of paying 16, or instead of paying 32, you can pay 16. Now, if a person said, okay, on my farm, I want to get back as much as I can get at 95%, you could say, Trevor, instead of getting 50 cents on the dollar back, I want 100, right? So your premium will go from $16 to $32. But then all of a sudden your max liability goes to $93, $94 an acre, so you can get back twice as much. It just depends on how much a person's comfortable spending. Same scenario in beans. It'd be a 95-50 policy, 50% liability on 1,000 acres, a 60 APH. So at 60 APH, 95% of that is 57 bushels. This policy only costs $12.50, 57 cents. The people I saw yesterday said, Trevor, this is a no-brainer. we want to do this. And the reason is because they have the high trigger and it pays back faster. The liability on this is $32. So they're paying $12 to potentially get $32 back, but at the high trigger of 95%. So they have the high trigger, they're just not getting as much back because they're paying half as much, which I like. You're sticking your toes in and not diving in head first. Now, we talked about the My Yield endorsement. So here's the other part of this policy that's very interesting. So this is a 95/50, you get 50% back. The difference is instead of using your APH, which would be 60, you're getting your highest yield you've ever had per farm. So in this example, we have a guy that had 62 bushel beans. It's about 4 bushel better than his actual production on that farm. So he's getting an extra 4 bushel of coverage at 95%. It's costing him $17 to do that to get 34 back. So it's about a 2-to-1 return, but he's getting credit for 4 bushels that is above his average. So 95% of 62, all of a sudden now his trigger is closer to 59 bushels. So he's really, really close to being above his average on the farm for actually getting paid on the insurance. Every county rate is different. So if a person's interested in this, get a hold of me. We can go through the math on it and see if it makes sense. So far, it's been hit or miss for me, right? It's all about return on investment dollars for me. I really like the 95, 85 policy with the APH. Does the My Yield endorsement get pricey? It absolutely does. But if you have a farm or two where it makes sense, we can look at that too. Now, to give you an idea how good a deal this is, so this is the same county, right? Very close. So we have an 85% RP policy, optional units. Now, we just saw on the 95% coverage, for $16, you can buy 95%. Well, the 85% optional units is $25. So you're $9 more on this policy on optional units than you are on the band. Now, in the enterprise, if you were going to compare apples to apples, it's still $16. So 85% essentially is costing you the same that the 95% is costing you. The difference is at 85%, your gross per acre on the 200 average would be right around 800. On the 95%, you're closer to 900. So for $16 an acre, you're getting about $100 more in revenue guarantee across each county crop, right? Especially on corn. So to me, to spend $16 to get an extra $100 of guaranteed revenue, that starts to get in a no-brainer category for me because we're more like 5.5 to 1 return on our dollars if there's a claim. Now on the beans, to me, it makes just about as much sense. So the optional units, 85% on the beans is $17. You can buy the 95% policy on this on beans for $12. The enterprise version of this is still close to $12. So they cost about the same, but the difference is your yield guarantee on this is going to be 95% of 60, right? So we're almost 6-7 bushel better on the guarantee, but we're only spending $12 to get that 6-7 bushel extra that pays you back faster, right? And the key to that, the reason a person buys it is my goal is to pay for the rest of my insurance if there's a claim, right? So that band, that 3-to-1 return on that band is going to pay for RP, hail, and any additional loss. The RP might not trigger whatsoever, but if you have that higher guarantee, it's more likely to pay the rest of your crop insurance bill. All right. So now I'm going to open it up to questions. That was a lot to cover in a short time frame. The same meeting yesterday I had was about 2 hours to get guys through the same topics. I wanted to keep this condensed because the key for me is if somebody is on this webinar, watches it, and says something on here was interesting to me, I want to make sure that I get with you individually and go over it because you're never going to catch it as much as you would, in questions on this webinar. Silas, do you have any questions from anybody watching that was curious about something we went over?
I do not see any questions at this second, but I'm going to just unmute anyone
Sure.
in case they do want to.
Sure. If there's anybody that has questions, feel free to ask them now. If not, please reach out to me individually. Like I said, it's almost impossible. I mean, I'm talking about these every day. So I'm going through it, probably talking fast. It's hard to catch all of it. If somebody wants to learn about how all these works, just reach out to me. This is my cell phone and my email. I live with my cell phone on me. Shoot me a call. If I don't get it, shoot me a text. I should get back to you the same day. But I really do appreciate anybody that jumped on here. We covered a lot, but these are easily the most excited I've been about private products in a long time. We're covering a lot of different options here and problems that guys have been looking to get covered. So yeah, I'll turn to Silas. If you don't have any questions, I guess we'll cut it. And I appreciate everybody jumping on. Silas, you got anything for me?
I've got no questions, but guys, we have a recording of this and we'll send it to everyone if you want to review any further. Otherwise, just get in touch with Trevor. Thank you.
Hey, thank you guys. You have a great day and stay out of the snow. Thanks.